Palantir is one of the fastest growing companies in the world right now, and it seems like its stock price is on a rocket to Mars. The stock is up more than 5 times in just the last year, and more than 14 times since it went public 5 years ago. Government contracts, explosive revenue growth, AI at its core, it checks all the boxes. So why am I sitting here telling you to be careful? It's because while the business is booming, the stock itself might be a trap. And if you don't understand the difference, you could end up holding the bag, just like investors did with Cisco in 2000 or Zoom in 2020. In this video, I'll break down why Palantir's fundamentals are outstanding, why the hype might be justified, and why the price tag could still ruin your returns. I will also use my intrinsic value calculator to show what needs to happen for the stock price to be justified. Stick around till the end to find out exactly how much the company has to grow over the next decade, so the stock price would be fairly valued today. Let's start with the obvious. Palantir is an exceptional business. Whether you love it or hate it, the numbers don't lie. In the first quarter of 2025 alone, their revenue surged nearly 40% year over year, and the company is now generating over $370 million in free cash flow, which is up nearly 150% from the same quarter last year. That is not just good, that is elite. Profitability is improving, margins are expanding, and management is guiding for even more growth in the coming quarters. And the demand is real. Palantir works with both government and commercial clients. It offers AI-powered platforms that help solve complex problems, from supply field optimization to battlefield intelligence. It also just closed 139 deals in one quarter, including 31 contracts worth over $10 million each. And that's a pace most software companies can only dream of. And what's fueling all this? The world is shifting fast. Rising geopolitical tensions, cyber threats, and the AI arms race is pushing businesses and governments to modernize. And Palantir is right in the core of that transformation. If you're looking at revenue, cash flow, and demand, Palantir checks out all the boxes. This is a company on a rise with real moat, sticky clients, and strong market share. But a great company doesn't always mean a great stock. So let's talk about the elephant in the room. Right now, Palantir is trading at almost 600 times earnings and more than 250 times free cash flow. Those are not just expensive tech stock numbers. Those are nosebleed, ultra-speculative levels. Even some of the hottest growth names during the 2021 bubble weren't as extreme. Now sure, high valuations can sometimes be justified. If you're growing like crazy, if your margins are expanding, and if the runway is decades long, then maybe, just maybe, you can afford to trade at premium multiples. But here's the problem. Even by the most optimistic assumptions, Palantir would need to grow its free cash flow by nearly 40% every single year for the next decade just to be fairly valued today. Let that sink in. Not priced for good returns, not priced for outperformance, just to be fairly valued. And that's assuming zero recessions, no margin compressions, and no slowdowns in government spending or commercial adoption. And I haven't even mentioned their dilution yet. Since 2021, Palantir has increased its share count by 8.7% per year. So even if a business performs, each individual shareholder's slice of the pie keeps getting thinner. Put bluntly, Palantir isn't just priced for perfection, it's priced for fantasy. And in investing, even the greatest businesses can become bad investments when you overpay. Take Amazon in the early 2000s. An amazing company, but investors paid over 300 times earnings. When the dot-com bubble burst, Amazon's stock fell over 90% and took years to recover. Microsoft had a similar fate. Dominant company, but if you bought at the peak of the year 2000, it would have taken you more than a decade just to break even. The problem? Massive overvaluation. And Palantir today shows similar warning signs. Investors hype it up with buzzwords like AI and geopolitical tailwinds, but that doesn't guarantee returns. The lesson here is that quality matters, but only at the right price. So far, we've seen that Palantir is priced for perfection. But what exactly does perfection look like? Let me show you using my intrinsic value calculator. Let's do an intrinsic value calculation based on their free cash flow. In the last 4 quarters, Palantir did 53 cents per share in free cash flow. Now let's say they will grow at 30% annually over the next decade. If they manage to do this growth, I would expect them to trade at a higher multiple, so let's give them a 30. So according to these assumptions, for a 10% annual return, you would have to pay around $80 for Palantir today. Okay, let's give them a 40% growth for the first 5 years. The company still looks overvalued. How about 35 for the 5 years after that? Still overvalued, but getting close. So let's say it will be trading at 35 multiple. Now, the stock seems like it's undervalued. Now let's look what happens if a company struggles a bit. And let's say that Palantir will grow at 25% annually for the next 5 years. And let's say we hit a recession and Palantir starts growing at only 15% for the 5 years after that. During recessions, multiples usually shrink, so let's give them a 20. And suddenly, it looks like the company would have to drop around 80% to be fairly priced today. You might call these pessimistic assumptions, and you might think that this may never happen. But honestly, do you really think that 25% growth for the next 5 years and 15% growth for the 5 years after that is actually that pessimistic? So for today's price to make sense, Palantir doesn't just need to keep growing, it needs to sustain almost 40% growth for the next decade. At the same time, the company would have to maintain industry-leading profit margins and avoid major dilution. And that's a tough ask for any company, even one as innovative as Palantir. We are entering a world of economic uncertainty. Yes, defense budgets are rising, but what happens if the commercial clients pull back during a recession? What if interest rates stay high or AI competitors catch up faster than expected? Even small bumps in the road, a slowdown in commercial deals, delayed government contracts, tighter margins could all derail Palantir's entire valuation story. And investors often underestimate just how long great growth has to last for a stock like this to be worth holding at a premium price. The point here isn't that Palantir will fail. It's that the price is too high. You're not betting on a great company, you're betting on flawless execution for the next decade. And history hasn't been kind to that kind of optimism. Wait, are you still here? Either I'm making sense or you're watching out of hate. Either way, the subscribe and like buttons work for both. Jokes aside, I guess what I'm trying to say is that Palantir looks like it's in a bubble right now. And usually bubbles do not feel like bubbles. They feel like momentum. Like everyone's finally catching on, and missing out is worse than overpaying. And Palantir investors show classic signs. A strong business, heavy media hype, and a passionate fan base. But that's just how bubbles start. There's always some truth. Look at Tesla, Zoom, Shopify, or Cisco in the dot-com era. Great companies, but buying at a peak meant years or even decades just to break even. When hype beats numbers, logic fades. The key isn't just if Palantir is good. It's whether you're paying the right price for the risk. And if not, maybe it's time to step back. So where do I stand on Palantir? Great business? No question. Palantir is delivering real value, has strong leadership, and is operating in a sector that's only getting more important. Strong growth? Absolutely. Revenue, free cash flow, and deal flow are all moving in the right direction. And fast. But great investment at this price? That's where I have to draw the line. At almost 600 times earnings and more than 250 times free cash flow, you're not just investing in Palantir's future. You're paying for the perfect one. One where growth never slows, competition never catches up, and government contracts never get cut. And that's simply not realistic. As value investors, we do not bet on perfection. We bet on undervalued potential. Companies where the upside isn't already baked in the price. With Palantir, the price assumes too much and leaves no margin for error. So what should you do? If you already own it, maybe take some profits. If you're on the sidelines, stay patient. Amazing businesses do not always make amazing stocks, especially when the hype gets ahead of the fundamentals. At the end of the day, discipline beats excitement. Don't let fear of missing out dictate your decisions. Let valuation guide them. Now, if you're interested in stocks that are undervalued right now, I have just released a video with my top 3 picks for July. You should be able to see it somewhere on the screen or in the description down below. If you enjoyed the video or have any suggestions, leave a comment. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.